And so the news just continues to be very exciting about the technology revolution that's driving what I think is the roaring 2020s. Yeah, no, I'm still bullish. I think it's a bull market. So instead of tweaking my year-end forecast, I'll start focusing on next year's forecast, which is 6,000 on the S&P 500 and 6,500 for 2026. Then by the end of the year, the decade, I think we're going to see something around 8,000. So these are all sort of my base case, 60% most likely roaring 2020 scenario.
I'm pleased to welcome back Dr. Edward Yardeni. He is a president and chief investment strategist at Yardeni Research. And we'll be talking about his work and Yardeni Quick Takes, which is a service that you can subscribe to. Very interesting work. Thank you very much, Dr. Yardeni, for coming back.
Sure.
Great to have you.
Thank you.
Let's talk about first your outlook on the stock market. So a few updates from some big banks. Goldman Sachs updated their outlook to 5,600 points by the end of the year, which is not too far from where we're currently at, 5,400. Right. So is that more or less in line with your expectations? Steady growth, not a huge breakout, but just sustained momentum.
Well, sure feels like a melt up already, quite honestly. Yeah. I mean, I don't know if it's sustainable. It's just been kind of vertical straight up here.
I will mention to the audience, you've been right. So you were on my show last year. You've been calling for a sustained momentum. That has happened. So congratulations on that call.
Thank you.
Basically, we'd just like to know if this is going to continue.
Well, here's the thing. Last year, I thought the market would get to 4,600 by the end of 2023. We got there by the middle of the year. And I decided I'm not going to play games with the market. I'm going to kind of hang on to 4,600 and close at 4,800. So not too far off the mark, but I do have some hoof marks from the bulls stampeding over my forecast. And the same thing's happening this year. I started out with a very bullish scenario. I think really just among the most bullish on the street at 5,400. And a lot of people thought that was delusional. And here we are at over 5,400, and it's the middle of the year.
What do you think? What do you think contributed to this melt up? Before we get your outlook, I mean, it can't be the Fed. They haven't been more dovish. Right. It can't be, inflation. I mean, what's your take on what happened?
Well, one of the things that's very encouraging is the economy has continued to grow. We haven't had a recession, and we're seeing that earnings are increasing. Analysts' expectations for earnings over the next 12 months, so-called forward earnings, are an all-time record high. And so analysts are getting more and more optimistic about the outlook for company earnings because they're not as concerned about a recession. But then again, we also have the valuation multiple for the overall market, probably almost at 21 on a forward earnings basis. The technology sector last week was up over 6%. It was the only sector that was up, outperformed the S&P 500, which is a very rare development. I think it's happened 4 times since 1991. But there's been a tremendous amount of excitement about artificial intelligence. And the reality is these technology companies have reported some pretty fantastic earnings. We've had the Oracle and Broadcom recently. Of course, NVIDIA has been a big champ. And so the news just continues to be very exciting about the technology revolution that's driving what I think is the roaring 2020s.
So before we get into some of the economic indicators to look at, then overall, then your outlook for the S&P 500, are you sticking to your call that you made last year? Are you more neutral now, or perhaps even seeing a bearish pivot? What's your take?
Yeah, no, I'm still bullish. I think it's a bull market. So instead of tweaking my year-end forecast, I'll start focusing on next year's forecast, which is 6,000 on the S&P 500 and 6,500 for 2026. Then by the end of the year, the decade, I think we're going to see something around 8,000. So these are all sort of my base case, 60% most likely roaring 2020 scenario. And then on top of that, I've got a 20% case scenario in which this turns out to be a melt up very similar to the 1990s. And I'd tell you, the past week or so, it's felt increasingly like it might be that 1990s scenario.
Well, we all know what happened at the end of the Roaring
Yeah,
Twenties, Dr. Yardeni. If you had to speculate as to what event could bring this music to an end, so to speak, what would
yeah.
that be?
Well, I think you sort of hit the nail there with regards to the comparison to the 1920s. The reason the 1920s ended badly, in my opinion, and I'll admit there's a lot of controversy about it, but I think the Smoot-Hawley tariff that was passed in June 1930 was the main cause of the global depression and the crash that we saw in the stock market. The stock market bust, the great so-called great crash, started late in 1929, but during the first half of 1930, we regained 50% of what was lost. It was not a real terrible situation, but then June 1930, they shut off world trade with the Smoot-Hawley tariff, and the market took a huge dive, and that shut off a lot of business, a lot of trade. And the similarity to the current situation is we've got whether it's Biden or Trump or who knows who might be, given the unsteady performance of both these individuals. But right now, the Biden and the potential Trump administration are talking about imposing massive tariffs on China, and so the Chinese are going to move and produce more in Mexico, and then it's going to be pretty hard to slap tariffs on Mexico because of the trade agreement. But I would say protectionism is the main risk to this upbeat outlook.
Before we continue the discussion, I want to take a minute to talk to you about today's sponsor, NordVPN. On this show, we regularly cover how to grow and protect your assets, but one of your most important assets is your privacy. Every investor needs to protect their digital privacy and footprint against hackers and potential viruses. According to Chainalysis, 2022 was the biggest year ever for crypto hacking, with hackers stealing $3.8 billion in cryptocurrency. And according to Duke University, more than 80% of US companies claim to have been successfully hacked. One of the best ways to protect yourself and your privacy online is with NordVPN. Not only does NordVPN hide your identity online from malicious actors and criminals, but it also comes equipped with malware protection. NordVPN also prevents you from accessing dangerous websites, allowing you to enjoy your favorite financial content securely. And the best part is that it is easy to use. Just download and click. NordVPN is available for your phone or computer, and they're currently offering 65% off on a 2-year plan plus 4 extra months. Simply click on nordvpn.com/David Lin in the description down below to learn more. That's a very good point. I've heard that before. If we were to get more protectionist measures, I wonder whether or not the economy today can sustain or is more resilient than the late 1920s and 1930s. In other words, could domestic consumption still continue despite perhaps even higher tariffs?
Well, I think it possibly could. The economy has demonstrated that it's very resilient. It has withstood this sharp increase in interest rates remarkably well. All the reasonable reasons that people gave for the stock market to go down along with the economy haven't worked out. And we were in the camp saying that the economy was resilient and there would be no hard landing. And we're still got plenty of hardcore hardlanders, as I call them, who think it's we're either in a recession or one is coming. The way I look at it, if we get, it depends. I mean, we could have some tariffs that aren't as calamitous as what we had with the Smoot-Hawley tariff in 1930. But once you go down that road and you start to get other countries retaliating, it can become a wicked situation.
Well, let's talk about the economy now.
Sure.
You have many charts on Yardeni.com, which I encourage people to check out. I won't have time to go through all of them. I'll just pick a few that I've selected, starting with the NFIB Small Business Survey, which is a good indicator for business optimism. As you know, small businesses account for the majority of U.S. GDP. Now, here you have percent planning to raise average selling prices going down in a straight line ever since basically the middle of 2022, and it hasn't been going up. Does that signal to you, worrying or more worries from the small business sector?
Well, small business owners' optimism index has really been quite depressed. You would think that we're kind of falling into a recession if you look at the chart on optimism. Then you look at some of the other charts where they complain about not having enough workers and that they can't find skilled workers. It's like you scratch your head and say, well, Are they depressed because their business is so good and they're frustrated that they can't get help? Is that what's going on? So I think all in all, small businesses are doing relatively well. They're not as dependent on credit as you would think. There are questions in that survey about credit availability, and they're not really screaming that there's a real problem there. But I think most of the problems seem to be in the labor market, not being able to get enough workers and enough workers with the right skills to work for them. And until recently, they had a real problem with people joining them and then quitting real quick, which is terrible for running a business.
Well, the key chart here is the optimism index. The NFIB optimism index has been trending down steadily over the last couple of years.
Right.
What would you attribute this declining optimism to?
Again, I think it's the frustration they're having with their payrolls, with keeping workers, with attracting workers with the right skills. When they do have a question in there about job openings, and that's been coming down, but not dramatically. It just in May, it actually rose rather sharply, and all in all, remains at a level that's consistent with a very tight labor market.
The number of corporations with over $100 million of assets going bankrupt in the U.S. has been rising. It's still not at historic high levels,
Right.
but the trend has been up. Is that a concern for you?
Well, I watch it. It's a concern. I mean, just because I have an optimistic scenario doesn't mean that I put on blinders and look at any of the negative news. But honestly, David, I find that there's so many people that are pessimistic, and there's so many very smart uh, commentators on the economy and the stock market
Sure.
that have basically done all the work for me on what could go wrong. That in trying to provide some in trying to provide some balance, it kind of boxes me in into being a bull and an optimist, which I guess I naturally am, anyways. But I do think that what the pessimists have been missing is the resilience of the economy, the resilience of the consumer, and I think that that continues.
I believe you've told other media like CNBC that the Fed doesn't need to cut rates this year. I
Right.
don't know if I'm paraphrasing you correctly here.
Yeah,
Is that what
yeah,
you
you
said?
got it.
Okay. Why is that?
Well, I think the proof is in the performance of the economy. The economy continues to grow. We've got initial unemployment claims. Yeah, they've gone up for the past 3 weeks, but let's not get bent out of shape here. This can be a volatile series. If it keeps going up, it'll get my attention for sure, and I'll recognize that I must have been missing something in the labor market. But there's so many other indicators suggesting that the labor market is doing well that I think the consumer will continue to do real well. So again, my take is that we don't really have to worry that much about the economy, and that if that's the case, look, if the economy is doing well, the unemployment rate's been at 4% or less for the past 30 months, and inflation is continuing to moderate. We haven't had to have this Phillips curve relationship. We haven't had to have a rising unemployment rate to bring inflation down. It's come down all by itself quite well without the economy going into recession. So why mess with success? Why not conclude that maybe the economy that interest rates are normal? They're normalized. I know they look like they've tightened, given that the Fed funds rate's gone from 0 to 5.25%. But guess what? This is where interest rates were. This is where the bond yield was before the great financial crisis and all the kind of abnormality that the Fed imposed on the credit markets. So I think we're back to where we should be, and the economy can perform well. I think if the Fed starts cutting interest rates when it's not absolutely necessary, in other words, if they cutting it before I agree that they need to do it, in that kind of scenario, I think you're going to continue to see a melt up in the stock market, and then instead of the 1920s, 2020s, we have to consider the late 1990s, and that's just too much of a good thing too fast.
Well, that's my next question, Dr. Yardeni. Whether or not they will cut rates, what they should do is one thing, and you've outlined a
Yeah,
case for why they should keep rates higher. But what they actually will do is another,
yeah.
where perhaps they're the same. What do you think?
Well, I think they've certainly seemed to be leaning towards cutting rates, but at the same time, they've tried to convince the markets that there are no rush. As you recall, David, the markets, a lot of investors were expecting 6 to 7 rate cuts this year at the beginning of the year. I couldn't understand where the heck that was coming from, given how well the economy was hanging in there. I think a lot of the hardlanders were just wrong in 2022 and 2023. And as inflation started coming down, they said, well, surely the Fed is going to now have to lower interest rates to avert a recession. And that's not the case. And right now, the Fed's talking about one rate cut this year and maybe late this year. So I don't really have a problem with that, but I don't think there's really any need for the Fed to lower rates given the admirable performance of the economy, the stock market, the bond market. Things are working out. Why mess with them?
Well, let's talk about inflation now. As you recall, Jerome Powell said in the last press conference that
inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets.
However, the last two prints, both CPI on a core and headline basis, have come in lower than consensus expectations. So where's it headed from here?
I think we're going to hit 2% for the consumption deflator by the end of the year or before the end of the year. Right now, if you look at the CPI excluding shelter is running right around 2%. So the CPI is there. And by the way, the PCED, the deflator, usually runs not as hot as a CPI. But shelter inflation is coming down. We know that it's coming down. We know that it's a laggard in the inflation cycle, and I think we're seeing it decline pretty much as predicted. So, a lot of the forecasters thought that inflation wasn't so transitory after all, and they all joined the persistence crowd that inflation is persistent. We argued that goods inflation would turn out to be very transitory, and it has been as supply chain disruptions have been resolved, and as the initial buying binge that we saw in the goods market has slowed down. And so we got non-durable goods inflation down to like 1.4% in the CPI. In the CPI, we have durable goods inflation down almost 4% on a year-over-year basis. And services, again, is the laggard because of rents, and that will come down as well. So I think inflation's going to hit the Fed's target at 2%, and we will, in fact, have achieved what many people thought was impossible, that to bring inflation down without a recession.
I asked this question on my show before, but I'm curious to get your take. Why is it that you think other central banks have already cut rates despite their higher inflation targets? Inflation rates rather. Bank of Canada, for example, I live in Canada. The current headline inflation rate is about 2.7%, much higher than the Bank of Canada's 2%. Yet they still cut 2 weeks ago. ECB, same thing. Why? And why is the Fed not ready to make that same move? Despite a similar gap in expectations or target versus reality.
Well, I think the Fed recognizes that they may be making a mistake, that there's no particular rush to lower interest rates. Of course, our economy has actually performed better than the Canadian economy, than the European and Japanese economies. So because the unemployment rate remains so low and the economy is so resilient, the Fed has the luxury of time. They can bide their time and, get a greater sense of confidence that inflation, in fact, has come down to their target, and just not for a month or two, but that it may very well stay here for a while. Look, the European Central Bank a week ago lowered their deposit rate by 25 basis points. And at the same time that they announced that, they regretted it, because they right away offset that with a lot of language that it might be one and done for a while. And that's because they recognize that maybe their inflation rate is still relatively high. The Canadian economy has this issue with housing. So a lot of housing speculation there. Maybe they want to take some of the pressure off that part of the economy. The Japanese have just been very, very slow in tightening it all. So much so that the yen has taken a huge decline. But I think the Fed's doing right. Usually the Fed leads other central banks in both lowering interest rates and raising interest rates. This time around, other central banks have jumped the gun, and I think the Fed is right in not rushing to to cut rates.
I don't really have a specific question to my next point. I just want to get your reaction to this.
Yeah.
It's reported on CNBC. Taylor Swift's record-shattering Eras tour is continuing to supercharge consumer spending as it enters the UK. As hundreds of thousands of dedicated Swifties flocked to London in August to see the beginning for the singing sensation, it could present complications to the Bank of England's rate cut decision, according to TD Securities investment analysts. This is what they say. We still anticipate a BOE cut in August, but the inflation data for that month might keep the Monetary Policy Committee on hold in September. What's your reaction to this?
Well, my reaction is that financial news editors are always looking for something interesting, and it's hard to find anything particularly interesting to the general public in financial markets. But what could be more interesting than to relate Taylor Swift's concerts to earthquakes in the UK and how it might create inflation for a month or two? It's fun. It's just fun. It's not anything serious.
Okay. Generally speaking, do you see interest rate differentials then pushing the dollar up for the next couple of months?
Well, the dollar usually does well when the U.S. economy is doing better than other economies, and I think that describes the current situation quite well. The Chinese economy is kind of muddling along with a very significant recession, maybe depression in the property market. They're trying to offset that by exporting more manufactured goods, which also means that they're exporting more deflation. So that's helping to bring inflation down around the world. When I look at the dollar, I have to believe that it's not likely to go down, and that might continue to go up. Look at the political chaos right now in Europe because of the parliamentary elections there that have brought in right-leaning parties, and there's a lot of concern that these parties are going to try to create less cohesion between the European Union and even the Eurozone countries. And so the French bond yield has soared dramatically relative to the German bond yield. Obviously, it makes the U.S. look like a safe haven place to invest. And we've seen the bond yield here coming down partly because of what's going on in Europe. Look, we're not exactly the most stable place politically either. We're approaching an election here that could be 50-50 with a lot of divisiveness around who's actually the winner. And it looks like both sides could take some very radical policy moves. Biden just keeping the current policies would be a very radical development without any reversal. And Trump is like Biden talking about raising tariffs dramatically on China, but Trump's actually talked about using tariffs as a way to raise total revenues for the government and eliminate the income tax. Yeah. I don't know who gave him advice, but that's Kool-Aid.
Oh, okay. I wasn't going to go there, but since you brought it up, is that technically feasible?
I doubt it. I seriously doubt it. And
that would be the cost would be just passed on to the consumers, especially the lower class, right?
Well, the other thing is it would be Smoot-Hawley all over again. I mean, that's what we're really talking about. You start messing around a little bit with trade before you know it, you got yourself a real disaster.
The counter argument I've heard of that is that the U.S. is a big enough market that people will have to export to the U.S. regardless of tariffs, right? Does that make sense?
Well, they might have to try to export to the U.S., but if the price is prohibitive, Americans may decide to make some of these things themselves, or even not buy them.
What about the labor market, Dr. Yardeni? The unemployment rate is now at 4%. We don't have a recession yet, but it's been trending up. Is it possible to have a further deterioration of the labor market without a recession?
Well, I don't really expect the unemployment rate to be rising much from here. I could be wrong about that. It has been inching up of late. There's something called the SAM rule, so that if it goes up to 4.1% from 4.0%, historically that would trigger that seemed to be a signal that we're in a recession or soon will be. So there's a lot of twitchiness about the unemployment rate. But again, I look at a lot of the labor market indicators, and they all look pretty good to me. And whether it's job openings or initial claims or continuing claims, jobs hard to get. That survey data is it shows that their jobs are not hard to get. And real wages are increasing. Wages are actually increasing faster than prices, especially for low wage workers, which is a great new development. So I don't see a scenario where the labor market's going to push us into a recession. Look, recessions are usually caused by credit crunches, and the economy doesn't seem to be having anything close to a credit crunch. The other way that you get recessions is with a big spike in the price of oil, and instead the price of oil has actually been coming down of late, notwithstanding all the geopolitical craziness that might affect oil coming out of the Middle East.
Well, credit card delinquencies for consumers is now currently at 3.16%. It's higher than pre-pandemic levels, still nowhere near as high as the 2008 level of 6.7%.
Yeah.
Speaking of credit crunches, is this an indicator for perhaps the consumer not being able to withstand higher rates for longer, do you think?
Haven't seen a situation where the consumer credit data really help you to forecast the consumer. And that's because it's employment that is the key to the consumer, not credit card debt. It's conceivable that some people have maxed out on their credit cards and they won't be shopping. But as long as the employment numbers are growing, I think we don't have to worry about losing the consumer. In other words, rising delinquencies don't cause recessions, but they do make the recession worse if, in fact, a credit crunch causes demand to collapse and then causes a recession, or if a spike in oil prices to such a degree that it forces people to cut back on spending in other areas, causes a recession. But I look at it, I worry about it, but I'm not worried to the extent of concluding that that's going to cause a recession.
Okay. And finally, sector outlook. You mentioned 6,000 points, the S&P by the next year. Which sectors are likely to outperform in your forecast?
Yeah, well, we've been bullish since November of 2022, early November, and so that was pretty good timing. And ever since then, we've been recommending overweighting technology, which in our minds includes communication services. So technology, communication services, industrials, financials have all done very well, and those have been our overweight recommendations. We've also recommended the one clunker is we recommended energy, which we view sort of as a shock absorber for geopolitical risk, but obviously hasn't done particularly well of late. But it's a really tiny sector, so it's not too hard to overweight it without really having a great deal of exposure there anyways.
Yeah. All right. Well, thank you very much, Dr. Yardeni, for your time. So where can we learn more about you, follow your work?
Well, about a year and a half ago, we decided to provide a service for individual investors. Most of our research is for institutional investors. That's where most of our business has been. But we have had a lot of people request some sort of slimmed down, quick read way of keeping on top of our thinking. So we created something called Yardeni Research, Yardeni Quick Takes. We got so many websites, I have to keep them straight here. You can simply go to yardeni.com and you'll find both our institutional product, and you can try that for 4 weeks, or else you can sign up for Quick Takes, which is a monthly service, monthly subscription service with a daily update. And the point of it is to show you how the macroeconomic data affects the markets and how the markets anticipate macroeconomic data. And we think that that's a pretty useful tool to have for investors.
Yeah. There's a lot of charts on there. So both Yardeni.com and Yardeni Quick Takes. So we'll put the links down below. I encourage the viewers to go check out your section on charts: global financial markets, U.S. economy, stock market, inflation, global economy, demography, which is an interesting topic that I love to talk to you about next time. We ran out of time today, but yeah, longer term trends, a lot of good information on there. So I encourage people to check that out. Well, thank you for providing these charts to the public. They're a great tool. Yeah. Anyway, thank you. We'll speak again soon. Thank you very much.
Thank you, David.
And thank you for watching. Don't forget to like and subscribe.